It's Thursday, February 17th, 2022, and today we're talking about paper becomes the newest Canadian unicorn. Cohere proves APIs are a scale economy business with a $125 million raise. Shopify misses expectations. 7shifts keeping Saskatoon hot with a $80 million raise. ODAIA raises $13.8 million for their AI-powered platform, and BMO commits $100 million for Black entrepreneurs. So let's get started. Let's get Alex on up here with me. Hey, Alex.
Hey, Leah. How you doing?
I'm good. Excited to be here today. So we're talking about the newest Canadian unicorn. I feel like every other week now we're talking about a Canadian unicorn. So what's the story?
First of all, I think there was a pause in news in the first few weeks in January. Now we're starting to heat back up. Way too much news to analyze every week. So let's talk about paper. They're Montreal-based. They raised $270 million USD in a round co-led by SoftBank and Sapphire Ventures, with backing from passive investors that include there's a long list: IVP, Salesforce Ventures, Framework Venture Partners, Bullpen Capital, Reach Capital, BDC Capital, and Red House Education. This round values the company at $1.5 billion USD, and according to BetaKit, this round included some primary and secondary sales. So that means not all the money was invested to grow the company. Some people took money off the table. Just one new person or fund I haven't seen invest a lot in Canada is Sapphire Ventures, which is a California-based fund-to-fund and direct investor.
Very cool. It felt like there was no one that missed that raise. So what does Paper do?
So Paper provides unlimited 24/7 tutoring support using sort of what I call a SaaS marketplace. So students can get help with their homework, feedback on work, or general support by tutors that are on the platform at any given time. And so they can do it basically any time of the day. Teachers get feedback on the tutoring so they can see where students are struggling, where they need help, where they're doing well. And administrators get a full dashboard. What's interesting is the school districts pay for the service and provide it free to students.
Very cool. But I feel like we just spoke about Paper in their most recent raise. So how are they able to do it again?
Well, yes, the company raised $110 million 8 months ago, or at least that's when the round was announced. What's more interesting is the company was founded in 2014, and prior to 2020, it raised, my guess is less than $5 million, and has had 4 rounds since 2020 started.
Oh, wow.
Including this one. So it's slow raising, and then, unicorn SaaS in 2 years with acceleration.
So how are they able to pull this off, kind of going from 0 to 60 so quickly?
Well, I wouldn't say 0 to 60 happened so quickly. It's probably from like 3 to 60 really happened quickly. So if you go back to the beginning of 2020, their run rate of revenue is up 25-fold. They went from 2 million run rate to 50 million in 2020 to, I guess 2021. Paper signed deals with the school districts in almost 30 US states. They now have 2 million students on the platform. Over last year, tutors tripled on the platform to 2,200. They increased full-time employees from 130 to 400. And what's interesting, almost all this business is in US. So you've got a company that just has seen accelerated growth over the last 24 months.
So why now? Like, why did this work now?
Well, what happened in March 2020? You remember?
Small things, yeah.
Yeah. And so I think the pandemic you had a pandemic which caused schools to close down and distribute devices and made devices essential to do at-home learning. And you had people worry about equality a bit more. And so those two trends fed into what Paper does. Because now if you provide an online platform of tutors, when 95% of students, 99% of students have the ability to actually take advantage of this, it becomes more feasible for the states or schools to pay for it. And second of all, with people more worried about inequality and education, this is a way to address it by saying, hey, we're going to give you free tutoring. So those two trends went into hyperdrive starting with 2020, and Paper was at the right places at the right time to take advantage of it.
So what should founders take away from this news?
Well, to a certain extent, timing is everything. Building a successful startup needs unique insights, but it also needs getting the timing right. In this case, when Paper launched, they had the right insights. There's a better way to provide support to students using technology. They had the timing wrong for the first few years. Like, they were around for 6 years before they basically revenue shot up. For many companies, this will be the death of the company. Lucky for Paper, they proved to be a resilient startup. They found ways to stay alive until their insights were paired with the right trends. So the easy takeaways for founders to be cockroaches and get to a default alive, where you have cash flow break even, you don't need more money. This is true, and it'll increase your chances of success, but you can't count on the timing of trends to catch up with you. Paper could have been, if who knows what would have happened if COVID didn't come, or the Black Lives Matter didn't resurge and become a big trend. Maybe paper would still be at 3-4 million revenue. So for many founders, realizing, I think the key takeaway is realizing that timing or insights are wrong, and then choosing to stay on course, believing that there's some green shoots that you're going to be right with your timing, or that your insights can be slightly nuanced and be right, or pivoting is a big question. And there's no right or wrong way to approach this. So it's a very hard decision for many founders. It looks great in retrospect if it works. The second takeaway is that finding product market fit is not the end of the journey. Most founders struggle to get product market fit. Okay, once we get product market fit, we're done. It's going to be easy, but it's really just the beginning. Post product market fit, it can be a very capital intensive business, any business, because you want to scale up as quickly as possible, and then the risk goes from actually finding customers that want you to scaling the company, and that's an entire host of new execution issues that can trip a company up just as fast as just as much as a search for basically product market fit. Finally, most VCs, when they look at tech investments over the last several years, they've been away from serving the institutions, be it universities or public sector schools, because they were horrible customers. Historically, it takes years to get a sign off on a new investment. If you miss your numbers, like if you don't get that sale in by August, you miss a whole calendar year, so you're not going to make your numbers and you have trouble raising. So raising money for ed tech that serves the incumbents has historically been very hard. And there's many industries like that. If you talk to many VCs, they don't want to touch anything with government. They don't want to touch anything with lawyers. But this proves that if there's a huge market and you got the timing right, when it changes, it can change really quickly and create a massive opportunity, which is what paper is taking advantage of right now.
That's awesome. And for more insights on what's happening in the Canadian tech ecosystem, you have to be following the TechTO newsletter. So this week, Alex, or actually today, you wrote tips for pitching. Can you give us a sneak peek into some of your insights?
We've started these new long form Thursdays. Lots of times there'll be guests who are much smarter than me writing about something happening in the ecosystem, trends or stuff like that. I'll be writing a trend once a month about how to improve your pitch deck. So everyone knows the slides to include. Everyone takes these standard template examples. My goal with these columns is to explain how you can take a page, and today we're talking about the competitor slide, and make it much more impactful, so it doesn't become a throwaway slide that you include just because you think you have to include it. So if you want to know how to make your competitor slide much more impactful, read today's newsletter.
And if you're not already subscribed, make sure you subscribe at techto.org. So next up, Cohere raises 125 million USD. Alex, what is the news here?
So, as you said, Cohere raised a lot of money from Tiger Global a mere 5 months after raising 40 million from Index Ventures. This round had participation from Radical Ventures, who previously invested Index and Section 32. Yeah.
So what does Cohere do?
So Cohere uses natural language processing, which is part of ML or AI, to provide understanding of semantics, sentiments, and tone, which improves the ability for software to communicate with humans. So if you're using a chatbot, if you had the AI underneath it to really understand the context, to understand your sentiment, it could improve how it would become from a frustrating experience to hopefully a joyful one. What's interesting here, Cohere is not building it for themselves. Well, they're building it for themselves, but they're building it to be accessed via an API. So all the companies who need to have chatbots or don't want to make this part of their business their core part can access it on a API basis, and they're like almost like the AWS for communication layer of technology.
So cool. I feel like there's a bit of a UFT AI mafia starting. Can you tell us a little bit about that?
Well, yeah, Cohere's founders are UFT alumni. They worked, the protégés of Jeffrey Hinton, and AI and machine learning take a lot of money, and to basically scale up the models, make them work, especially when you're using an API model. We'll get to that in a second. But you're seeing these people that are trying to, did AI at U of T and were part of Jeffrey Hinton's like lab are all slowly departing and raising lots of money. You have Cohere, you have Wabi, who we talked about, Raquel before, Deep Genomics, and Untether. All of them have raised hundreds of millions of dollars to basically create startups that take advantage of the learning in the machine learning.
Well, we should be keeping an eye on this huge wave of AI folks coming out of U of T. So what are their plans for the capital that they've just raised?
So continue to build the product, continue to educate it. They're going to build an office in Palo Alto. Who they've hired Apple's former director of proactive intelligence. So my guess is they're basing there so they can have a distributed team, but have get lots of talent in the valley. Improve the product. Lot needs people and needs to be trained.
So what should Canadians take away from this story?
So this is almost the exact opposite way of building a company of paper. You've got a company here who's building an API model. And the idea behind an API model, and it's a fairly new one. So this is AWS, this is Twilio. There's a bunch of other ones out there. It's probably a model that you didn't see much before 10 years ago. Is the concept here is you have a startup and you're building a core distinctive part of your business. There's a bunch of other stuff you need, and you need to use it on demand because you don't want to overbuild it. Why should you build it? Let's get a third party to build it, and we'll pay as we use. So what an API model needs, it says, okay, we're going to be best in class to offer the service. So what Cohere is doing is they're building the best model for human-robot interaction or human-computer interaction. It takes a lot of upfront development to build the model that works, to train it, then to build API and service it. So there's like a high fixed cost, but then they sell to these startups or enterprises that pay per use, and that use is basically huge margin. So if it's the API model is like, let's put a capital expenditure up, spend 50 million, 100 million, sell it on pennies per minute or pennies per interaction, but that's a pure profit. So very different model. So what you have to have belief here is that you don't have to get the trend right. You have to believe. You have to have an insight in something that's many companies are using that they don't want to be basically, like, again, an example, Stripe. No one wants to build their own payment processing. So that we're going to build a best in class. It's going to cost us a lot of money up front, but we'll have a high margin business. So you have to believe that there's a use case, that you can build something that's great, and that you know how to go to market. So like I said, opposite approach of paper, you need to be able to raise money. So probably the difference success here is you need to be credible founders. So maybe be part of Jeffrey Hinton's inner relationship. You have to believe that there's some valuable software that people don't want to build themselves and raise a lot of capital. And then this is really a massive business or a massive failure, nothing in between. And then the last thing I'd say here on a society level, the payoff of fundamental research in our universities, especially in AI across this country, keeps on getting shown because you had these people that go get attracted to go work with these professors, go research these areas, and eventually they're leaving to commercialize it. And they're starting the companies in Toronto and Montreal and Alberta. They're attracting people, capital and money and people from all over the world and helping create our economy. So a lot of times our universities get questioned. I just like to see us keep on doing fundamental research, and not just in machine learning and NPL and AI, but like quantum or any other technology that we could benefit from by having fundamental breakthroughs on.
Well, speaking of last week, that the whole quantum story is based in the same sort of theory that we need to be paying attention to these things.
Exactly.
And with that, there's a few other Canadian rocket ships you need to be watching. And you should actually be out voting for your favorite Canadian rocket ships. We're putting together our 2022 list. Tomorrow is the last day to vote. So make sure you follow us on Twitter, LinkedIn, and Facebook to tell us how you can vote for your favorite Canadian startups like Cohere or Wabi. Alex, who are you going to be voting for this year? Can you give us a little insight?
No, that I'll have the editor's choice with the name. And just for people who don't know what a rocket ship, these are the companies you think people should join to take their career to the moon.
And if you haven't already, you should check out our last year's 2021 list. We had some fantastic folks that have gone on to to build really successful companies that we've been talking about sort of endlessly on Quick Takes. So highly recommend checking out last year's list and voting for this year's list. And speaking of rocket ship companies, we actually have a new segment for you folks today. Every week we'll be profiling an insider company that you need to be following and checking out. So we're kicking off with Maker Kids. Alex, why should folks be watching Maker Kids?
Well, so first of all, let's give some context here. So what we're featuring is, we have an insider program, which is like our membership program. We have an active Slack community. And so Jennifer, the founder of Maker Kids, is a big contributor to that company, and she has a very interesting business. So would love to highlight our company and tell you who you get to know by being part of our insider program. So Maker Kids offers award-winning virtual program for kids aged 6 to 13 on everything from coding to robotics and Minecraft. The goal is to help kids build both technical and social emotional skills. Project-based curriculum with live real-time instructions embeds lessons that help kids build confidence, social skills, resilience, and a positive relationship with technology. And what's interesting, from talking with Jennifer, this business took off over the last few years. It used to be an in-person cohort-based training, and she moved to a digital class, which focused more, not just, like she says, not just training the kids how to do like code in Minecraft, but social responsibility and social skills. And at least in Toronto, it seems like every second parent I talk to has registered kids for a course. So she's big ambitions. She's trying to make a difference. And I'm super excited to have her as part of our insider program.
Do you think that she benefited sort of the same COVID wave that Paper did, where folks are moving at home? Now we're wanting to get our kids more involved with?
I think a different way, because it forced her to revisit from first principles her business model, and she learned new ways to reach more customers, and so now she can do it in digital native fashion versus in person. So there is a definite benefit here, but it wasn't it wasn't a fundamental shift in how people purchase, because I think people were looking online before, but it made her figure out, how can I do this online, and made it a more scalable business.
And Jennifer is an awesome insider. Make sure you're following Maker Kids and following Jennifer, and join the insider program so you can chat with her in Slack. So next up, Shopify misses expectations. Alex, what's the news?
Shopify reported, actually, it didn't miss expectations, it changed expectations. So they reported its Q4 financials and going forward projections, and investors were disappointed. The results came in, they had 41% year-over-year growth. So they had like $1.38 billion dollars in revenue, USD. They had a loss of $370 million USD, but that was more a reflection of some of their public companies they hold, like a firm, going down in value, so it's a mark to market. This were both, the profit or loss and the revenue were both beat investors' expectations. But what happened is they announced two things which people weren't happy about. One was that revenue growth would slow, and two, that they're changing their approach to the warehouse and fulfillment network strategy, and they would have to invest $1.2 billion over the next 3 years.
So what happened to its share price, and why did this happen?
Well, so two very different questions. So yesterday it fell between 15 and 20%, depending on the time you looked at. In the last 12 months, it's down 50%. It happened because, basically two things I mentioned. Shopify said their growth is going to slow this year, and they're going to deploy a lot of money into capital expenditures.
So we never discuss public earnings. This might be our first time doing this on Quick Take. So why is Shopify the first one that we're discussing?
Well, first of all, I think everyone and their mother's probably discussing Shopify's earnings, and I try to avoid it because we don't have any advantage in talking about public markets. But I think it's important to discuss Shopify. They are a current face of the Canadian tech ecosystem and are national tech champion for lots of people, especially outside of tech. And our previous national champions, Nortel and BlackBerry, sort of had inglorious demises that happened quickly. And there's sort of feeling that lots of public sector, lots of people in the public are like, oh, same thing will happen to Shopify. And while everyone in the tech ecosystem wants Shopify to show staying power and to show that they can be national champion and Canadian companies can take on the world.
So should we be worried about this change in expectation, or what should we be focusing on?
So short answer is no. Why am I not worried? Shopify continues to grow extremely fast for a large corporation. They're continuing to invest in the future and show the ability to learn and adapt. A great example is their new fulfillment plan. What they had originally announced wasn't working. They looked at there's a better way to do, or they found a better way to do it, and they were bold enough to say we're going to invest in this, and we don't care what the short-term ramifications are because we know in the long run it'll create more value. And other examples, they've announced NFT storefronts. Maybe NFTs are fad, maybe they're not. I don't think they are, but NFT could easily let someone else build an NFT storefront and not worry about. But they're out there quickly adopting, and they have like a crypto team. I'm pretty sure.
Mm-hmm.
If anything, I think Shopify is more relevant than ever from a strategic perspective, in a better position than they have ever been. Some of the swings in profits are due to corporate investments, so they've been pretty bold at investing in companies privately. And when the publicly traded companies are going up, it added to their bottom line. Now that their valuations are going down, like a firm is down like 30 or 40%, they have to show a loss. So it's irrelevant from a cash flow perspective. So I'm not worried.
So why should founders be paying attention to this news? What can they learn from it?
So a couple things. One is just generally, when you look at the public markets, and you can say even private markets, the value at any given time may not reflect the true value of the business. In this case, Shopify's true value is probably not its peak. And I don't know what its current value might be higher than the current value, the current market cap, because the true value should be based on what the company will do in the future. And I see a company here that's investing to keep on growing and being a massive business in the future. So I sort of ignore public market valuation. That's what we normally don't talk about. For founders, if you're looking to raise from a Shopify angel, it might be a bit harder. Like, even though if they're long-time holders, they may feel less wealthy today and be less likely to invest. There is an investor psychology you have to be aware of with angels. If you're looking to raise capital for SaaS business, your valuation comps have fallen. And this because it's not only Shopify, but any SaaS type business that's publicly has basically fallen in value over the last 6 to 12 months. So if you're looking to raise at an early stage where comps, your valuations haven't changed, be modest so you don't outprice the market, because the later stage, the longer these values stay lower, the less value you're gonna get as a private company. If you're recruiting, it may now be the time to check in with Shopify employees to see if they want to make a change in jobs. And last thing, ignore all the people outside of tech that now say, technology companies never work in Canada, because you're going to get the naysayers. You're going to say, let's invest in real estate, let's invest in natural resources. Yeah, gold's going to do well. Gold companies did well over the last 12 months, but the future is in technology. And if we don't invest there, there's nothing much I can say about this country.
Yeah, the rest of the world's investing in it. We have to catch up. So lastly, we're gonna wrap up with our quick takes. So first up, 7shifts raises $80 million USD. Alex, what is the news?
So that's how busy it is. We couldn't talk about an $80 million round today. 7shifts, who's based in Saskatoon, raised $80 million in a round led by SoftBank, with participation from 10 Coast Capital and Enlightened Hospital Investments. The company increased the number of restaurants they served by 60% over the past year to 27,000 locations, and doubled the number of employees on the platform to 650,000.
So what is the takeaway for founders? So
first of all, Saskatoon is building a small but thriving ecosystem. They're not the only company that raised big money. There's also like Coconut Software there. This is another example of a company like Paper that's serving a large market that had to basically hunker down for a bit different reason, but like they had to be proved resilient. But now they're getting what was headwinds have become tailwinds, and it seems like the company is thriving and going to, because they're at the right place, because they've positioned themselves well. Companies do back of the envelope numbers. I also think what's interesting is the company is being valued at roughly $14,000 per customer.
Oh wow. And they're hiring extensively. So if you're a follower of ours and you're looking for your next move, definitely check out 7shifts. We've actually had their head of engineering join us at our talent in the fall. So make sure you check out that video.
Maybe in the show notes, we can put the video.
Yeah, that's a great idea. We'll make sure that we include that link and also to their careers page, because they are hiring extensively with this new raise. So next up, ODAIA raises $13.8 million. Is that another UFT company?
Yeah, so basically ODAIA raised $13.8 million USD from a host of investors in the States. Also some Canadian investors, including Graphite Ventures, BDC, WTF, or WITF, Women Tech Fund, Mars IEF, Stand Up Ventures, which is another women-focused fund. So lots of, but yeah, I just want to highlight them because this goes back to the company was spun out of U of T and is based off using, artificial intelligence to provide insights to drug companies on how to do better sales. So again, see the impact of having strong research universities is demonstrated here once again.
Another UFT AI company. And lastly, let's wrap it up for BMO has committed $100 million for Black entrepreneurs. Alex, what is your take?
Well, just, we're all about diversity and inclusivity, and we like to highlight programs promoting inclusivity and diversity in the community. So BMO is offering $100 million. I think it's up to $250,000 loans. Like to see that it's targeted. It's going to help bring more entrepreneurs in the ecosystem and make it a bit less risky to start a business. The one thing that wasn't clear to me, if there's personal guarantees, I hope there isn't, because that is a big problem for many people. Mm-hmm. Like when you're starting a business, it's risky enough. You've been up usually salary, and the last thing you want is a personal guarantee hanging over your head. So looking forward to seeing the details there, but I'd like to see more and more movement to make it easier for people to break into being entrepreneurs.
Mm-hmm. And we always want to support companies that are, or support initiatives that help promote diversity in the ecosystem. So that's all for this week. Thank you so much, Alex. And what a week in Canadian tech. If you haven't already, like and subscribe to TechTO Quick Takes podcast, wherever you're watching or listening. And we will see you on the inside. Thanks, everybody.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.